Welcome to Chapter 4 of Personal Finance. In this chapter, we are going to talk all about different types of financial services. So let's go ahead and jump right in. So we already know there's a lot of different payment choices, so I'll just kind of blow through this quickly. But you can pay with cash, which not a lot of us do, but sometimes financial experts recommend that so that it can help you to not overspend, not spend more money than you have. Of course, there's checks also, but my guess is a lot of you haven't even ever written a check before because that's not a very popular way to pay anymore. Credit cards or debit cards are definitely going to be the main ways that we pay, but also online or mobile transfers. And this can include anything from PayPal, Zelle, Cash App, Venmo. So I know I use some of those really often. All right, so frequent money mistakes that we should try to avoid. One, overspending due to impulse buying and overusing credit. These are things we've already talked about, but we want to make sure that we really understand that impulse buying, something that you didn't plan to spend money on at all, can really mess up your budget. So, as we talked about in chapter 2, you can actually put a line item for impulse shopping in your budget if it's something that you really enjoy and say, you know what, I am going to allow myself to make a random purchase up to $100 a month. And that's because I know that's something I'm going to want to do, and I do have the money in my budget to do so. Overusing credit is something we can all fall into so easily because credit allows us to spend money that we don't even have yet, which is a really scary concept. And that is why so many people get into debt, even at young ages. And if you're thinking to yourself, it's fine, I'm young, it's going to take care of itself, I'm going to make more money later anyway, who cares? Well, hopefully you will make more money the older you get, but it doesn't mean it's going to take care of itself. One, you're getting in the habit of spending more money than what you make, and that will probably just follow on through the rest of your life. Two, even though you may make more money, you will likely have many more expenses with the older you get. So getting into debt when you're young is very foolish, and I would highly recommend that you stay away from that kind of thinking. All right. Two, having insufficient liquid assets to pay current bills. Remember, liquid assets are things that can quickly be turned to cash. So this could be just your money in your checking account. So you want to make sure you have that available so you can pay your bills. Make sure that you are putting those bills before you're putting all those fun things that you have going on. Using savings or borrowing to pay for current expenses. So you really want to try to avoid that. Avoid getting into debt to pay for current expenses. Avoid using your savings. Try to live within your means, which means not spending more money than what you make. And if you can get that under control, you are going to be doing much better than a lot of people that you interact with. Failing to place funds not needed for current expenses in a savings account or investment. So a lot of times people are like, look, I paid for all my bills and now I have another $300 left. So let's go spend it. But that's where you really should be saving that money or even investing it so it can make money for you. You can't save money you don't have. You can only spend it, which is, yeah, very concerning. Types of financial services. So we know that when we go to a financial institution, we can get anything from a savings account, we can get different payment services, we can borrow money from them. And then there's other things like they can help us with insurance, investments, tax assistance, financial planning. They especially want to help you with financial planning if you have a lot of money to invest, and then they'll get much more of a commission when you go to these financial institutions. But let's talk a little bit about different types of online and mobile banking. So you know what an ATM is. One thing to consider is compare the different fees. So if you're going to be using an ATM a good bit, which is just where you use your debit card to get cash, if you're going to be doing that pretty often, then you want to make sure that there are free options available. You don't want to have a $4, $5, $6 fee every time you use an ATM because your bank doesn't actually have any free ATMs. So make sure you are aware of where you can get that money out without a fee. Very important. Um, Online banking, we know there's different payment services, whether you are doing things with your bank directly and you're able to deposit checks and transfer money and check your balance and all of that immediately, or if we're talking about something like Zelle where you are going to be transferring money to someone else. So we can make those deposits, we can put those checks in. There's all kinds of services that we can do with online banking, which is so handy. Just remember to be skeptical of things, especially when using Zelle. If you're doing any kind of transaction, make sure it's with someone that you know, because there's a lot of scammers out there that will try to attack you through Zelle. I've had that happen myself, and it's really can be easy to fall for those. A debit card. So a debit card it's just like what a check used to be, right? It's the same thing a check is now, but we don't use them much. So a debit card is going to be a card that you can only access money that is actually in your bank. So it's really convenient to have it because you can use it at the gas pump, you can use it without having to keep cash on you, but this will not it will not let you go into debt. It's only spending the money you actually have. So that is super useful. The downside of it is it's not helping you to build credit. So if you want to build that credit score up, which of course you would want that, right? Then you are not doing that with a debit card. But if you are tempted to spend more than what you have, a debit card can definitely prevent that. Prepaid debit cards can also be something that, especially for younger people, maybe the parents put the money on the debit card so that they can only spend that limited amount. So credit cards versus debit cards, there are good and bad things about both. So a credit card, great to use for several reasons. One, to delay the payment for a purchase. I mean, I guess that's an advantage. That's also a disadvantage because that means you are spending your future money, and spending your future money means that you've already made a decision with money that you haven't made yet. So I'm not a big fan of that part of it, but it can help you build that credit history as long as you are doing things wisely and you are making the payments each month. You know, you obviously need one of these cards to be able to buy online, and we all are buying things online now. So buying online, using it for a major purchase. And what I love about a credit card is that I earn points every time I use my credit card. So I'm really big on earning those points. But whatever the points are used for, whether it's cash back or miles or hotel stay or whatever it is, if you're not paying your credit card off 100%, every single thing you spend on your credit card every month, then your fees, your interest is way higher than any points you're going to get. So you're losing out on all of the free point advantages if you're paying interest. And the only way to avoid interest on a credit card is if you pay off the entire balance, not just the minimum payment, but the entire balance every single month. If you can't do that, you should not have a credit card because you are just going to dig yourself deeper and deeper into debt. Debit cards. So that limits your spending to just what's available in the bank. It avoids having a future bill, like, you know, you're delaying the payment till later. You don't have to worry about that with a debit card, so that's good. You don't have to pay interest. Shouldn't be any annual fees with it. And with both of these, you have extra protection. If you lose $50 when you're at the fair, like, you kind of lost that $50. You're not going to be like, that was my $50. Kind of hard to prove that. But if you lose your debit card or credit card, you can, you know, put a stop payment on that. So that's really important with those things. It gives you that extra protection. Comparing financial institutions, when you're thinking about which bank to put your money in, some things you might want to consider is like, where can I get the best return on my savings? So where can I get a high interest rate? A lot of times it's online banks that offer that. In fact, what I would tell you to do if you're looking for a bank is to go to nerdwallet.com and look for their top 5 recommended banks. They're always doing like top 5 of what they recommend, and they've done a lot of research on, and that can show you where you could get the highest interest rates. But a lot of times it will be online banks. So you have to consider, do you want a place that you can go into and talk to someone as well? How can I minimize the cost of checking payment services and other fees? So make sure before you get into it, like, okay, they're paying a high interest rate. Oh, but you have to keep a $5,000 minimum balance. I didn't know that. So, make sure that you know what all of the different fees are they charge, the minimum balances, the ATM fees, all that kind of stuff. And will you be able to borrow money if you need to? You might say, I want to find a bank to put my money in, but I also will probably want to get a car loan soon. So, is that something that the bank can provide for you? So, it'd be good to look at that as well. Some different types of financial institutions. So we have commercial banks, which are what we usually see. These are your Bank of America, Wells Fargo, that kind of thing. So they offer a full range of financial services, all the different things you can look for. They are organized as corporations. They are going to have investors that are contributing capital. They are going to be making a lot of profit off of the interest from loaning people money and the fees that they charge. There are some other financial institutions you may not have heard of as much, though. Saving and loan associations. These just specialize in savings accounts and mortgages. That is all they specialize in. They don't offer all the services. Mutual savings banks. These are owned by the actual depositors, by the people who are putting their money in the bank. They also specialize in savings account and mortgages. They're mainly Northeast US. So I live in the South and I've not seen banks like this. I'm not aware of banks like that here, but they're mainly seen Northeast. There's also credit unions. You've probably heard of a credit union. They're user owned, lower fees, lower rates, but you typically have to have some kind of in with this. A lot of times it's like someone in your family's been in the military or lived in a certain area or gone to a certain school, something along those lines, in order to get in with these credit unions and get those special rates. So, problematic financial businesses. There are some businesses that are just scams. They are there to take advantage of people who are in a bad financial spot. So, we're going to jump into what those are. So, there's pawn shops. Now, if you're looking for some kind of deal on some kind of antique or some instrument or something, a pawn shop might be a great place. It's a local shopping mall, but it's also known as the neighborhood banks. So the reason that this is a problematic business is not necessarily for the shoppers, even though I haven't personally seen great deals at these places, but I'm sure they're out there. But they are more problematic for those who are borrowing money for them. So let's say you go in there and you say, I really need money to pay my rent. I'm going to give my grandmother's ring. So this ring is worth $5,000. It's a diamond and all this stuff. And you go to the pawn shop and they say, okay, we'll take the ring. It is worth 5,000. We'll give you, 2,500. You're like, oh, okay, wow, okay. And they'll say, look, we'll hold on to the ring. You come back in 2 weeks with that $2,500 plus a significant amount of interest, and we'll give you your ring back. If you don't come back and you don't extend it or anything, we're going to sell that ring. So they're either going to make a bunch of interest off of you, or they're going to sell your item and make a big profit. So using a pawn shop is not a great idea because there's going to be a lot of interest, even if you do go back and get your item back. Check cashing outlets. So here, okay, I don't have a bank. I'm going to have to go in and cash my check with them. Well, they're going to hold a significant amount of your check. The interest rates are usually between 1 and 20% of your check that they're going to hold. So go open a checking account. Don't go through it this way because they're just going to take advantage of you there. Payday loan companies. So here you're saying, I need my money now, but I don't get paid till Friday. It's Tuesday. So you go and write them a check. You say, don't cash this until Friday, and they'll lend you the money. But again, they're going to take out a huge percentage of that. They're going to charge you a bunch extra for the interest. So you write them a check for $500, they might give you $400. So they're going to charge you a significant amount for that. Rent to own centers. So we see this with different furniture companies, appliance, electronic companies. You go in there and you say, I need furniture, but I don't have all the money right now. And they say, that's fine. You can just rent it and eventually you'll even own it. Well, typically it'll be at least double by the time you've paid for all of it. And usually their furniture is not cheap anyway. And then they will charge you about double, if not more, over the life of you renting that. And finally, card title loan companies. So here you go in, you give them the title of your car and you say, can I just borrow some money? They will give you money, but they want you to come back and pay interest. If you do not come back and pay that interest and you don't renew it or anything and keep adding to your interest, they will take your car. So now you don't have the money and you don't have the car. So the crazy thing with all of these is when they talk about interest, they're not just talking about like any other situation. When we say, oh, it's 5% interest, we're talking about for the entire year. With these companies, if the car title loan company says we're going to charge you 5% interest, they're talking about just for the week or two. So if you borrowed $1,000 and it had 5% interest, if you did that at the bank, it would be 5% for the whole year and you pay $50 on it. If you do that at car title loan company, it's 5% just for that 1 or 2 weeks. And then if you extend it, they're going to charge you another 5% for another week or two. These average anywhere between 300 and 700% interest a year if you were to keep extending the loan with them, which people do all the time. So these companies are just out there to take advantage of people in desperate situations. So try to avoid these at all costs. All right, now let's move to something not so extreme. So comparing different savings plans, we have regular savings accounts. They have a low or no minimum balance, but they usually pay low interest as well. Certificate of deposit, we usually hear that just called a CD. You're tying up your money for a certain period of time, but typically you could get a little bit more in interest on these. So you might be tying up for 30 days, for a year, for 5 years, but they typically will pay you a little more interest. And the bank's doing that because they say, hey, lend us your money. We'll give you a little bit of interest. We'll give you 3%. And then we're going to go lend this to somebody else and charge them 7%. So that's how banks make their money. There can be interest earning checking accounts. Usually the checking accounts are very low interest rates. Money market accounts and different funds like that, these typically have a higher interest rate, but they're going to have a significant minimum balance that is required. So, and they'll have other requirements, like you can only write this many checks or use this many debit card transactions, but they are going to have higher interest rates because of those terms. There's also bonds, which since we're in chapter 4 and we had jumped to bonds already before this because we mixed things up a bit, you've already heard about bonds, but it's a safe investment in most situations, and it can earn interest for anywhere from 30 days to 30 years, and you get paid for that every 6 months, but it usually has higher interest than you find in these other accounts. So annual percentage yield, you're going to see this whenever you look at different accounts and how much you're going to earn. This takes compound interest into consideration. So if you were going to be paid that interest every month, even though it might be 4% a year, if you're paid 1/12 of that every month, it's actually going to end up being more than that. Now, if you're the one in debt, you're the one having to pay the interest, you're going to pay a higher interest rate than it's stated because you actually have to pay every month. So this is calculated by taking the interest payment divided by the principal amount. And then we multiply it by 100 to make it a percentage. So an example would be $66 in interest divided by 1,200, and then you multiply it by 100, and you're going to have 5.5% interest in this case. All right, now let's move to writing a check. So while you may not write many checks in your life, I don't write a lot of checks either, but I do probably every couple of months or so. For some reason, I need to write a check. So this is the check. There's always a check number in the top right-hand corner, and that will help identify whether or not a check has gone through or not. And while personally we don't use a lot of checks, companies still use tons of checks. They still receive tons of checks, and that check number is vital to keeping track of the payments and everything. So we always put the date. On the pay to the order of, we're going to write the name of the company or the person that we're writing the check to, and you want to be specific so that somebody can't do anything with it they're not supposed to. Then you write out on that line below it, you write out, like if it's $1,500, you write 1,000, ONETHO. You're writing it out in words, 1,500, and then it says dollars already. And make sure there's a line all the way to the end so nobody can fill in anything else. Then in the little box, we write it numerically, $1,500. In the memo, you don't have to put anything there at all. That's more for you when you go back to your online banking. You can be like, wait, what did I write that check for $1,500? Oh, that's right. It was a down payment for this car that I bought. And you could write that in the memo line. It's not required. And then you always have to sign your checks, of course. And at the bottom, it has the routing number, which is going to be the same for the whole state for different types of accounts, and then your account number. And then you see the check number repeated. So that's what's on a check there. All right, then we have a check register. This is not something we use as much unless you're in the business world, but I always saw my grandma and even my mom use this, where when she wrote a check, she would record it and then keep track of how much she had in the bank, because they weren't able to get online and see their accounts constantly like we can do. Like, okay, I want to make sure I don't write a check and then I wrote it for too much and then I'm actually out, or I go over my account balance. So they kept track of it this way. But companies do still, in some way or another, electronically keep track of it like this. All right, we're going to end with a bank reconciliation. This is where we compare what the bank statement says we have to what we have kept track of. So this is where we get the bank statement at the end of the month, we put the balance there, and then we write what balance we've kept up with, assuming we kept up with our balance as well. And this is assuming we haven't looked at our bank balance for the whole month, pretty much. And companies have to do this all the time. This is a huge process for them. Not as much for us because we really can check our accounts anytime we want to, but you still have to know how to do it in the personal finance class. So, but the balance may be different because something may have happened in the bank that we didn't know about, or something may have happened on our side that the bank doesn't know about yet. So the first thing is an outstanding check. This is where we wrote someone a check, but they haven't cashed it yet. So the bank has no idea. So if it was a $100 check, they think we have that $100 and we're like, oh, no, we don't have that. Because at any point, Sally can go and cash that check and we don't actually have that $100. So if that's the case, if we see that's a difference, we're going to write on that outstanding check, subtract $100. There could also be a deposit we made on the last day of the month. We put in the little overnight box that has not shown up until the next month. The bank didn't know that month that we made that deposit, and so we may have to go in and add that to our bank statement. So then we take the bank balance, subtract any outstanding checks, add any deposits that we had made after hours that last day of the month. That gives us our adjusted bank balance. Then on our checkbook side, we write what we had kept track of. Then we look at the bank statement and say, oh, there were some fees, some ATM withdrawals that we didn't write down, so we need to subtract that from what we thought we had. You may also see that you earned some interest, or you even had some direct deposits come in from your job or something, and you want to add those as well. So those are things that the bank knew about that you didn't realize. So then when you subtract out any fees and withdrawals, you add any deposits and interest, then your adjusted checkbook balance should equal the bank balance. So you just have to walk through that process slowly and think everything through, and hopefully that will help you to get to the same number. It has to equal on both sides to make sure that you've done the right thing on both sides.